The income statement measures the economic performance of the period by comparing mainly the income from the business activity and the total expenses incurred to generate this income. When revenues are higher than consumption, called expenses in accounting language, the net income represents a profit. In the opposite case, a loss. Redcoat's revenue comes from the sale of nights in the hotel, charged at €800,000 for the year. Redcoat consumed €390,000 worth of materials and services, mainly the rent of the building, but also breakfast foods and clinic products. Redcoat employed staff for the sum of €280,000. This is a consumption of labor. The sale of nights in the hotel also necessitates the purchase of furniture at the beginning of the year for €190,000. Recording this amount as an expense would mean that the furniture has been completely worn out or even destroyed. However, Redcoat intends to keep it for 5 years. Based on this useful life, you estimate the annual consumption of the furniture, called depreciation, at €38,000. All these revenues and expenses are directly linked to the business activity of the hotel and therefore appear under the heading of operating revenue and expenses. There are also revenues from financial investments and expenses generated by the cost of financing. These items appear in the income statement as financial revenues and financial expenses. In our example, interest of €2,000 arises from the loan contracted by Redcoat. In addition, Redcoat is unfortunately taxed €30,000 on all its income. Net income or profit after tax was €60,000. It is possible to show two intermediary incomes. Operating income is composed of operating revenues minus operating expenses, and the financial income is composed of financial revenues minus financial expenses. When the income statement is shown in a vertical layout, the three main components of the net income are operating income, financial income, and income tax.